Good afternoon, everyone, and welcome. Thank you for being here. My name is Kurt, and I'm your presenter. With us today, I know we have a lot of federal employees. I know you're going through difficult circumstances, so I've created a slide at the end that you might find helpful. Today, we're going to spend about half an hour talking about what's new in Social Security and Medicare for this year and what that might mean for you. Before we dive into that, I want to tell you a little bit about myself, my company. Again, my name is Kurt. I'll be teaching today's class. We'll review our slide deck, and then if you have questions, I'm going to have you email those to me. I'll have my email address, my full contact information up on the very last slide. This presentation, it's educational. It is not a sales pitch. I'm not here to sell you anything. And let me be clear, I'm not an expert on Social Security or Medicare. I know quite a bit, and if needed, I can refer you to an expert or get them involved in our conversation offline so that you get the information you need. My company, Turning Point Financial, is a registered investment advisor. Our home office is located in Frederick, Maryland. The SEC is our regulator. We're fiduciaries, we're independent, we're a team of 30, and we offer financial planning, investment management, tax services, insurance. We do everything that everybody else does. We do have our own way about us, though. I specialize with federal employees, and our firm knows your benefits well. Obviously, we're talking with a lot of your colleagues these days. Here's the topics we'll be touching on. Social Security paid a substantial cost of living adjustment this year. We'll talk about how this COLA, as it's known, is determined. We put it into context. We see what it means for your benefits going forward. Another number affected by the COLA is the earnings test threshold. We'll talk about how much you can earn this year without being penalized if you claim Social Security before reaching your full retirement age. Next, we talk about taxes, payroll taxes and income taxes you pay on Social Security. For those interested in Medicare, we'll go over the new Part B premiums for this year and see why it's not such a straightforward number anymore. We'll also cover the dates to watch in 2025. We'll give you an update on the status of the trust fund. I know that's a popular topic. We're going to discuss some ideas for reforming the system to make it more solvent for the future. And we'll give you an update on Social Security claiming strategies. Lastly, brand new legislation repealed the windfall elimination provision and the government pension offset. That's number 8. These provisions affected people who worked in jobs that didn't pay into Social Security. That's our agenda. That's what I'm going to be covering. We're not going to be talking about when is the best time for your family to turn on Social Security benefits. It's not a black and white answer. It involves so many other areas of your financial life. I'm only saying this to save you some time if that's the reason you're here. I do have some very timely articles that a client sent me today that I'm open to sharing that speak directly to that topic. If you'd like those, send me an email and I'd be happy to share it. Again, I'll have my email address up at the end of the presentation. We'll start with the cost of living adjustment, the COLA. In October of every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited number, that's the COLA, or the amount by which Social Security checks will be raised. Another number is the new earnings test threshold. And finally, the maximum amount of earnings on which Social Security taxes are assessed. The COLA for this year, many of you know, 2.5%. This means if your current benefit is $800, you're getting an extra $20 a month. The higher your benefit, the higher your COLA. If your benefit is $4,000, which would happen if you're a maximum earner and you claimed your benefit at age 70, you'll be getting a cost of living adjustment of $100 a month. The annual COLA, it's varied over the years, averaging about 2.6%. The trustees of Social Security project a 2.4% COLA going forward. The COLA is based on the CPI, or Consumer Price Index, for all wage earners. The CPI measures the change in a basket of goods and services that a typical urban worker might buy. What's that mean? It covers food, transportation, housing, entertainment, healthcare, and pretty much everything people spend money on. In any case, the COLA is announced each year in October, and it takes effect with the Social Security checks that go out in January. Even if you haven't started taking Social Security, let's say you're delaying to age 70 to get the bigger amount, your benefit is raised by the COLA. So when you do claim, you can be sure it'll be reflected, it will reflect each year's COLA. If you want to know more, you're interested in learning about the COLA calculation, check out the website here on the slide. Okay, so that's our first big number change. Next, we're going to get into the earnings test. This speaks to anyone who plans to work and collect their Social Security before full retirement age. That's the FRA you see on the screen. The earnings test threshold is affected by the COLA. As you probably know, if you're under full retirement age and you work and receive Social Security benefits, part of your benefit may be withheld. They withhold $1 for every two that you earn over the threshold, which is now $23,400. If you're in less than that 23,400, no benefits withheld. If you're under full retirement age and you have the opportunity and the ability to work, it's probably better to earn as much as you can and delay applying for Social Security. There's another one, a new threshold for the year in which you turn full retirement age, $62,160. The higher the threshold, this higher threshold comes into play if you were receiving Social Security last year and you turn your full retirement age this year. The months leading up to the FRA, $1 of benefits withheld for every $3 you earn over the $62,160. Once you're full retirement age, all that goes away. No more penalties. We're not going to say too much about this slide here, other than first year earnings test is different than other years. Some of this stuff can be really dry. I want to keep things moving and focus on what's most relevant to the majority of the people. Okay, having said all that COLA stuff, earnings test, I want to take a moment and get into payroll taxes. The maximum earnings subject to Social Security went up to $176,100. This means higher earners will pay Social Security tax on more of their earnings. But remember, Social Security taxes represent a pretty good investment in the form of inflation-adjusted income that lasts for life. The more earnings you have and the more Social Security taxes you pay, the higher your benefit will be. And remember, as long as you're working and paying into Social Security, your benefit will continue to be adjusted. If you improve your earnings record, your benefit may go up, even if you've already started collecting. If you're interested in seeing how the Social Security Administration calculates the earnings cap, check out the link on the slide. The Social Security tax rate, it did not change. As employees, we all still pay 6.2% in payroll taxes on our earnings. Our employer pays the same amount. Folks that are self-employed, have their own business, they pay both parts, total at 12.4%. Medicare tax also didn't change. That is still 1.45%. Here's the math. We don't need to say anything more on this slide. That takes care of payroll taxes, or the taxes collected to fund Social Security and Medicare. Now we're going to talk about the taxes on your actual benefits, which are a little bit different. Since 1984, Social Security benefits, they've been subject to some level of tax depending on your other income. This table shows the taxation of Social Security benefits based on various income levels. Income in this case means provisional income, which includes adjusted gross income plus 1/2 of your Social Security plus any tax exempt interest. Most folks here today, they're above these numbers. If your provisional income is under 32,000, no benefits are subject to tax. If your provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. And if provisional income is above 44,000, 85% of those benefits are taxed. For single folks, the thresholds are a little different, 25,000 and 34,000. Same for married filing separately and living with spouse, 85% of your benefit is taxable regardless of income level. These income thresholds never adjusted for inflation. That's obvious. So more and more people are having to pay income taxes on their Social Security benefits. The important thing to remember here, 85% of your Social Security benefits may be subject to tax, depending on how much other income you have. What does that mean? Let me summarize. Social Security is taxed based on our provisional income. Provisional income includes all your sources of income. That's required minimum distributions. That's your pension. Could be part-time income, rental income, investment income, and your Social Security. That's how it works. And for many of us, that means 85% of our benefit will be taxable. We have two ways to keep our provisional income low. One is with the Roth IRA, and the other is with cash value life insurance. These are topics we covered in our other webinars. We don't have time to dive into those today, unfortunately. Moving along. The law recently changed with regard to RMDs, required minimum distributions. You may remember it used to be age 70 and a half, then it was bumped up to 72. Well, in 2025, it's now 73, and later on, it's going to be age 75. If you want help figuring out your RMDs, let me know. The thing about RMDs is that you may have had all your income and your tax situation figured out, and then you have to start taking required minimum distributions from your IRA. If you don't plan ahead, these RMDs, they can bump you into a higher tax bracket. In addition to having to pay income tax on the RMDs, they may cause you to pay more tax on your Social Security benefits. Again, this speaks to the value of the Roth. And it's certainly a good idea to plan for those taxes ahead of time. Those of you who are still well in advance of your RMD age, you might want to start drawing down those assets so the RMDs don't force you into that higher tax bracket for Social Security. Your operative word here is might. Beating the Social Security tax, it might not be worth it, pending other tax considerations. This is an area where you want to be working with your financial advisor and your CPA. You may also want to convert to a Roth IRA, which generates tax-free income. There's another way to pay less in Social Security. It's to delay it. Reduce the number of years your income is subject to that tax. This is not the main reason to delay benefits. Delaying is mostly advantageous because of the higher benefit from the delay, but it also certainly helps with the tax situation. Okay, we're moving on to Medicare premiums. The Part B base premium is now $185 a month. Even if the base premium is lowered, some people will pay more due to the income-related monthly adjustment amount, better known as IRMA, which we dive into in a couple of minutes. If you're on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there's a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. This year, the Social Security COLA, it was 2.5%. We talked about that. The Part B premium, it went up by nearly 6%. In most cases, the dollar amount of the COLA was higher than the dollar amount of the premium increase, so the hold harmless provision doesn't apply. All right, folks, hang with me. These next few slides, they can be a little dry. The issue that's going to be affecting more people is the IRMA, or again, income-related monthly adjustment amount. It's applied to their Medicare premiums. IRMA is an extra premium you must pay if your modified adjusted gross income exceeds certain thresholds. This year, that first threshold, $106,000 if you're single, $212,000 if you're married. Modified adjusted gross income for this purpose is adjusted gross income plus tax-exempt interest. Your premium each year, it's based on the tax return you filed 2 years ago. So if you're on Medicare, your 2025 premium, it's based on the income you reported in 2023. But if your income has changed due to a specific life-changing event, such as retirement, you can appeal. In other words, if you reported high income in 2023 and you've since retired, you can appeal the higher premium. This table here, this shows Part B and Part D premiums for different income levels. If you're single and your income's under 106 or married and your income's under 212, you pay the regular Part B premium of $185 a month. There is no adjustment. If your income falls into one of these other tiers, you pay an income-related adjustment on top of the base. The more you make, the more you pay, and this is where tax planning can help to keep your reportable income lower, which we covered with how Social Security is taxed. Keep in mind, these are per person. So if you're a couple, you can double these amounts. Your tax return from 2 years ago is used to determine this income-related adjustment. For example, the adjustment for 2025, it's based on your income reported on your 2023 tax return. And keep in mind, the premiums shown here, they do not include premiums for drug plans, Medicare supplement plans, Medicare Advantage plans. This is Medicare only. Whether you are already on Medicare or getting ready to start, we're going to get into some key dates that you need to pay attention to. Take a look at these. This slide sort of speaks for itself. And then a few more dates. The annual open enrollment period for people on Medicare, October 15 to December 7. September of each year, you receive information from your current plan about their offerings for the next year. Premiums may be going up. Your coverage might change. There might be new plans in your area. If you currently have a Medicare Advantage plan, you want to see how it'll change for the next year. If you have original Medicare, you want to see how your drug plan will change for the next year. Then you're going to want to look at other plans offered in your area to see if any of them might be better. If so, you contact the new plan by December 7th. If you do nothing, you'll be re-enrolled in your current plan. That's how it works. That's a lot to think about. Okay, the slide you've all been waiting for, the future of Social Security. Actually, it's our next few slides. Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers, me and you, they go into the trust fund, and then they're immediately paid out to current retirees. Because baby boomers, they've been in their peak earning years, the trust fund, it's accumulated more than is needed for current benefits. Right now, that trust fund, it holds nearly $3 trillion, and that's invested in Treasury securities. As baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves in the system that they'll be able to pay the promised benefits until 2035, 10 more years. After that, if nothing's done to reform the system, income will only be sufficient to cover 83% of promised benefits. Then what happens? Although the Social Security system is not in imminent danger, most people agree that the earlier reforms are instituted, the less painful they'll be on all of us. It's really just a math problem that involves increasing revenue, cutting benefits, or a combo of the two. Here are just a few of the ideas that have been proposed. One, increase that maximum earnings subject to Social Security. Currently, $176,100 of earnings is subject to the 6.2% tax paid by me and my employer, you and your employer. One way to shore up the system is to raise the earnings cap or just get rid of it. Another reform calls for raising the full retirement age. Currently, full retirement age is 66 for people born between 1943 and 1954, and age 67 for people born in 1960 or later. An argument in favor of raising the retirement age is that people are living longer. An argument against it is people whose occupations involve hard physical labor, they really can't work until age 70. Still, another reform proposal would change the benefit formula so that future increases would happen at a slower pace. This would affect the benefits of all future retirees, and some are talking about changing the formula for the cost of living adjustments. This could give retirees smaller benefit increases going forward, although the changes are expected to be minimal. Given there's lots of ways the Social Security system can be reformed, is Congress likely to address the issue this year? Probably not. Other issues are taking priority, and because of the nearly $3 trillion trust fund, benefits are not in immediate danger. Many of you remember the last time that Congress made major changes to the Social Security system. That was 1983, and the trust fund was within a few months of running out of money. Theoretically, Congress has 10 more years until 2035 before they have to worry about that happening. Okay, I want to talk to you briefly about claiming strategies, even though these may not affect all of you. And a couple we're going to go through very quickly, like this one. We're going to skip because it doesn't impact anyone here today, and it's actually no longer available. File and suspend was nice while it lasted, but no longer applicable. Same thing with the next one. Doesn't exist. Claim now, claim more later. Congress abolished this in 2015. So what's left? Well, we do have some good news. This one's important. I'm going to go over it slowly. It's one a lot of folks are not aware of. Although some of the spousal loopholes have been closed, it's still possible for a lower earning spouse to receive 50% of their higher earning spouse's PIA, primary insurance amount. That's the benefit amount, if the lower earning spouse's benefit is lower. Please note that if the lower earning spouse is claiming the spousal benefit before her full retirement age, the spousal benefit will be less than 50%. Also, the other spouse, they have to be taking theirs in order for the strategy to work. And if the higher earning spouse's benefit includes delayed credits because they're claiming after full retirement age, that spousal benefit doesn't include those delayed benefits. What they're talking about there in this jargon is age 67 to 70. That time, those 8% annual increases over that 3-year period, those are not included. Your spouse doesn't get those. They only get it up to the full retirement age, and they get a maximum of 50% of your benefit. All right, so this one's applicable to many of us, and it's certainly the one to pay attention to. January of this year, the president signed into law the Social Security Fairness Act that was passed by Congress, bipartisan support. The new law repeals the windfall elimination provision and the government pension offset for certain teachers, police officers, firefighters, and other government workers who didn't have Social Security taxes deducted from their paychecks. Under the windfall elimination provision, or WEP for short, anyone who worked in a job that didn't pay into Social Security and who also worked long enough in a Social Security covered job to qualify for retirement benefits, they had those benefits reduced by as much as $600 a month. With the repeal of WEP, this reduction was removed, and it's retroactive to January 2024. Spoke to someone this morning. They were in this circumstance, and they had recently received a nice check. It was the retroactive time period. So if you're affected by the WEP and have been receiving reduced benefits, your benefits, it's automatically adjusted. If you have yet to claim your benefit, rest assured there'll be no reduction for the WEP, no penalty for not having worked at a job that didn't pay into Social Security. You're going to receive your full benefit, the same as everyone else, without regard for your pension. Let me be clear that the WEP affected a very small percentage of people. If you've always had Social Security taxes deducted from your paycheck, this doesn't affect you. Government pension offset, or GPO, also affected people who worked in jobs that didn't pay into the system. GPO's been repealed. Teachers, government workers who would have had their spousal and survivor benefit drastically reduced or eliminated, they can now collect those benefits without regard for their pension. This is also retroactive to January of 2024. This impacted a very small percentage of people, and we're not going to dive into the details of that. Let's move on. In working with clients on Social Security, we found that sometimes people are missing out on benefits because they didn't know they could claim them. We have 3 quick examples. Here's a situation that's not terribly uncommon. A married person who never added on their spousal benefit after their spouse filed. For example, we would look to see if a lower earning spouse's benefit is significantly lower than 50% of their spouse. This could suggest that the lower earning spouse filed first and claimed their own small benefit. Then sometime later, the spouse filed for their larger benefit. This entitles the lower earner to the spousal benefit that's added to their own benefit, take you up to a maximum of 50%. But you have to apply for that spousal benefit. A lot of people don't know they need to do that. It's our first one. Next, Divorced person didn't know they could claim a spousal benefit off of their ex-spouse. Now, not everyone can do this because their own benefit has to be less than half of your ex's. If you've been working, your own benefit, it may exceed your divorced spouse's benefit. But it's always good to check. And the last one, divorced person whose ex-spouse has died. Sometimes ex-spouses, they don't keep track of each other. But if a person was married over 10 years to an ex-spouse who's died, they may be able to get a survivor benefit based on the ex-spouse's earnings record, which is higher than their own benefit. If you or anyone you know would like a Social Security checkup, we may be able to help you identify possible benefits, explore claiming strategies, and see how Social Security fits into the rest of your retirement income plan. And your participation today, it entitles you to a free consult with me. All you have to do is send me an email and we'll get something scheduled. I'll have my address up on another slide in just a minute. This is the one I mentioned early on in the presentation. Our audience today is mostly federal employees. I wanted to provide some ideas of how to manage what you're currently up against. You need to prepare for a worst case scenario, and here is how you do that. You're building up your bank accounts, especially that emergency fund, just in case. Find ways to save more and live in a more frugal way, and be ready to find something else. These are the things I'm talking about every day. And I know this is off of our topic of Social Security and Medicare, but it's important, in my opinion, and I hope you find it helpful. So that's it. That's what I have for you today on Social Security and Medicare. Here's my full contact information. Please reach out if I can be of any help. Again, your participation entitles you to a free consult with me. If that's something you're interested in, just send me an email or give me a call. We'll get something scheduled. If you have questions, shoot me an email. I'm happy to answer your question. If you want to know more about me and my firm, our website is on the slide, and you can also connect with me on LinkedIn. If you'd like a copy of the slides or you'd like to share this recording with someone, you're welcome to do so. Send me an email if you'd like a copy of the slides, and I'll send it to you. Share those. We're back April the 9th. We have a webinar that has to do with retirement planning. You'll get an invitation to that. So just like to say thank you so much. Appreciate you being here today. And look forward to hosting you at future events. Have a great day.